So the timing here is really interesting because while other hedge fund titans are running away from the proverbial burning building that is active management, Jeff Vinik is running back in after shutting his hedge fund in 2013 and returning $6 billion to investors. Vinik says, quote, "The fire in my belly still burns." But much has changed in 6 years. Capital has flowed out of active management and into passive. Computers are trading a majority of the daily flow in equities, and greater competition has made alpha even harder to obtain. Vinik, whose Vinik Asset Management was a long-short equities fund, says he's not deterred by any of these forces.
I think this is an incredible opportunity for, old-fashioned stock picking. We've had decades or, maybe 10 or 20 years of active managers underperforming passive managers. Money has poured into passive funds at the expense of active funds. The amount of coverage of companies on Wall Street has decreased. All these trends have kind of ignored the fundamentals behind companies, quantitative trading too. I think there's a great opportunity now.
Vinik also told CNBC that he believes the current bull market could last, get this, another 10 years. Thanks to good economic growth and low inflation, it's perhaps that optimistic outlook that's pulling him back into the fray, guys.
I love this, Leslie. Made my ears perk up because it's the sort of argument we've heard before, but it's being delivered by someone that hasn't been dragged down by the label of underperformance for the last sort of 4 or 5 years.
Exactly. He's been managing his own money. But you could tell, just sitting with him kind of in between breaks and before he went on, he is a stickler to the ticker. He loves watching the prices of securities. You could tell he just was really excited to get back into it. But you're right. It's a lot more fun when you think you're managing money in a bull market.
Yeah. And it would be a test of his style, right? Because today it's a different set of competitors. It's a different rhythm to the markets. So it would be interesting to see how he can, if he can pull it off. Also, exactly. I was half jokingly saying, if you think the markets are going up on balance for the next 10 years, index funds work. It wouldn't be the worst thing in the world.
Yeah, true. Leslie, great interview earlier. Thank you very much for bringing us that. Let's debate a little bit more this topic. BlackRock, by the way, announced today that it would cut 500 jobs, or 3% of its workforce, within the coming weeks. The company saying it will also invest to capitalize on its ETF business.
So we're going to have the debate now, that statement that Leslie just made, about whether active or passive investing is the best way to go this year. Todd Rosenbluth joins us from CFRA, who falls into the passive category, and Jeff Mills from PNC Financial Services Group, who is pro-active. So, Jeff, what makes this year different from the last decade or so where passive was the way to go?
Yeah, well, let me just say from a portfolio construction standpoint, we're always going to use a combination of active and passive, but we do believe that active management tends to be cyclical. And I think now you're starting to see the beginnings of a shift and possibly a better environment for active managers. What's happened over the past decade is the Fed pushed interest rates essentially to zero. It made it so uncomfortable to hold fixed income that it pushed investors out the risk curve, often into equities, often agnostic of price, often agnostic of quality. And what you got was higher correlations and a more difficult environment for active managers. And now, not surprisingly, what you've seen is as the Fed is starting to tighten monetary policy, you're seeing signs of that reversal. Hedge funds, kind of the most active of the active, finally eked out some outperformance in 2018, actually outperformed the broad market by about 700 basis points in December when things got really ugly. And then even if you look within style, so growth versus value, growth massively outperformed value, but 30% of individual value constituents actually outpaced the growth index. So for skilled stock pickers, there is opportunity in the market, and I think that value growth comparison is a good example of that.
Todd, do you see a shift? Do you think active can start to sort of justify its fees?
Well, they would have in 2018. That would have been a good environment. The stock market was volatile. The average fund declined. The average equity fund significantly underperformed the S&P related index, the large, the mid, the small cap, the growth, the value side of it. Fees are a big part of it. 100 basis point premium or more to pay for it. We haven't seen stock selection work. And in the fourth quarter, when it was volatile, the average active manager performed in line with the index. So if you want to reduce your profile or you want to enhance your profile, you can use index funds. They're not just passive vehicles. You can reduce it with low volatility. You can increase it with momentum. You don't have to just be static and be passive with these products.